Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Richtech Robotics.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Okay, so let's unpack this, because when you first dig into the financials for Richtech Robotics, you kind of hit this wall of contradiction.
You really do.
I mean, this is a company that's all in on service automation robots for hospitality, retail, healthcare. You'd think, explosive growth.
Right, you'd expect that top line to be soaring.
But the numbers, they tell a really confusing story at first.
They absolutely do. If you just look at the revenue, the picture looks, well, challenging. The trailing 12 months revenue, TTM, it's sitting around $4.13 million.
Which is not a huge number.
No. And that's actually down from the prior fiscal year. And even if we zoom in on, say, the last 9 months, revenue still contracted slightly, about 3.1% year over year.
So on the surface, it looks like they're struggling with sales momentum.
Exactly.
But here's the twist, and this is where it gets really interesting for anyone trying to understand the operational health of the business.
The gross margins.
The gross margins, they are dramatically robust. We are talking 76.08% gross margin TTM.
Which is just wow.
And to put that in perspective, that is a huge leap from 64.15% just the year before.
That leap, that's the whole story right there. We're talking about a 1,560 basis point expansion in gross margin.
In just 9 months.
In just 9 months. Now, a basis point is just 0.01%, but when you see a jump like that, that is not a small adjustment.
No, that's not an accident. That's a fundamental strategic shift in their model.
It has to be.
So what does that signal then? Is it that the revenue they're capturing is from, incredibly high margin sources?
It suggests that, yeah. Are they selling fewer physical robots and moving more into software services? Or their newer products just built for way higher profitability?
It's probably a mix of both.
I think it's both, and that's the positive sign. A jump like that says they've either totally refined their supply chain, or they are prioritizing things like ADAM.
The AI-enabled bartender.
Right. ADAM is a complete solution targeting a very specific market. So they're making more profit per dollar of sale, and that is the classic sign of a company getting real control over its unit economics.
Even while they're still fighting for that top-line scale.
Exactly.
But we have to keep one foot on the ground here. I mean, despite those phenomenal margins, this is still a high-burn company.
Oh, absolutely.
The net income is still negative, right? Around, negative $15.12 million TTM?
Yeah, this is a company in deep investment mode. They are just pouring those profits and more right back into R&D, sales, infrastructure.
So for us, that means the margin expansion is only half the story. The market needs proof. It needs proof that revenue acceleration is coming, and soon.
Which leads us right to the next question. Why are the margins so high? And what's their competitive moat?
What makes a customer stick with them?
It's not just the hardware. It's their proprietary technology. Their core strength is their AI-driven robotics IP, all centralized in what they call the AI Cloud Platform.
The ACP.
The ACP.
Yeah. And that platform is so crucial, isn't it? It's the difference between selling a shiny piece of metal and selling an indispensable operating system for a business.
That's a perfect way to put it. They're not just selling the Medtrade server robot or the DSE cleaning bot as standalone units.
No.
They're selling the ability to manage thousands of them from one central place. They want to be the super operator.
The super operator. And that concept, that is what creates those high switching costs you mentioned.
Absolutely. Think of the ACP as the central nervous system for a huge retailer. If your whole fleet of robots, cleaners, inventory trackers, even bartenders are all on one system.
You can't just rip it out.
Ripping that out to switch to a competitor would be prohibitively expensive and just massively disruptive.
It's like having to get brain surgery just because you want to switch your phone brand. The risk is just astronomical for the customer.
Exactly. And they really lean into that moat with deep vertical specialization. They're hyper-focused. Look at ADAM in hospitality.
Right, an industry crippled by staffing shortages.
Crippled. High turnover, can't find people. ADAM isn't a gimmick. It's a direct, automated solution to a multi-billion-dollar labor crisis. And that lets them command much higher prices and sustain those margins.
So the whole strategy, the proprietary AI, the central management, the full service, it all creates that customer lock-in.
And it gets stronger over time.
The data flywheel, right?
The data flywheel. Every robot on the floor gathers more data, which improves the central AI, which makes the whole platform smarter than any new competitor could be.
But again, that mode is only theoretical unless they can sell it at a massive scale.
Which brings us to the major catalyst that everyone's watching right now.
The big news, the reason we're even talking about a potential revenue inflection point.
The Master Services Agreement, the MSA, signed back in August 2025.
With one of the largest retailers in the United States.
And that is the ultimate validation. This huge retailer, they would have vetted Richtech's tech against everyone else. And they chose them.
So this MSA is the green light. It's the pathway to the revenue acceleration that justifies everything we've just talked about.
It is. This isn't just a sale. It's the large-scale monetization of their entire model. It's their shift toward that high-margin, recurring robotics as a service revenue.
Okay, so when do we see the numbers? When does this stop being potential and start being, well, reality?
Everyone is looking at the financial calendar. The first big show-me moment is the fiscal year 2025 10K filing.
Which should be around December 2025.
Correct. And investors need two things from that report. First, we have to see the initial revenue from that retailer MSA. It has to be there.
And second,
we need to see that those spectacular 75% plus gross margins hold up, even as they start to scale.
Right. If scaling kills the margin, the whole thesis is flawed.
Fundamentally flawed. And then the next report is even bigger. The Q1 2026 earnings expected around February.
Because that'll be the first full quarter of revenue from the MSA.
Exactly. That'll give us a clear, undeniable picture of the deployment speed and the real financial impact of this contract.
And they're riding some powerful macro tailwinds here.
Oh, for sure. The demand for retail automation is accelerating. Global labor trends are in their favor. The ROI for their solutions gets better every single quarter.
Now, we have to flip the coin. Let's talk about the risks, because there are some serious and immediate headwinds here.
Right. You can't talk about rapid growth without talking about the cash you need to burn to get there.
And that net loss did expand sharply.
It did. And the source of that loss is, well, it's eye-catching.
It was driven almost entirely by a huge 269% surge in general and administrative expenses. G&A.
For anyone listening, G&A is basically the non-production operating costs. Executive salaries, legal fees, stuff like that.
A 269% jump is alarming.
It is. Management says it's mostly one-time restructuring costs, compliance fees, legal expenses from landing that big MSA.
But still, 269% isn't just noise, it's a cannon shot. Doesn't that raise questions about their ability to manage costs as they scale?
It raises massive questions.
Mm-hmm.
And that number has to normalize. The market has like zero tolerance for uncontrolled G&A spend. If that line item doesn't drop significantly by the 10K,
the narrative changes from investment to mismanagement.
Instantly.
And then there's the other side of that huge retail win, customer concentration risk.
A big one. If one customer is driving most of your upcoming revenue, you are completely beholden to them. Any delays on their end.
And the story just collapses.
That risk is real. But it is mitigated somewhat by their financial buffer. They have, what, $32.89 million in cash on the balance sheet?
So they have some runway.
They do.
But that cash didn't come from nowhere, did it? We saw those controversial capital raises.
Right. The dual at-the-market offerings, the ATM agreements, in May and August.
Can you just quickly explain what that is?
Sure. An ATM offering means they can basically sell new shares into the open market whenever they choose, up to a certain limit. And, that caused a lot of near-term dilution and volatility. That's the bear case.
So why do it? What's the trade-off?
The trade-off is essential financial flexibility, securing access to a potential $100 million in capital. You need that.
To actually execute on the MSA.
To execute, exactly. It takes cash up front for inventory, for installation, for support teams. The capital raise actually de-risks their solvency and gives them the firepower to deliver on the growth story.
It turns a press release into a real business.
Precisely. And we've also seen some leadership changes, but it seems like they're professionalizing, bringing in new directors, building the corporate structure you'd need to support a huge enterprise contract.
So let's bring this all together. The core thesis here really is a margin expansion turnaround story.
I think that's the perfect way to frame it. You have these dramatically improving unit economics. Those confirm 75% plus gross margins. The foundation is solid.
And that foundation is now coupled with validated enterprise-level demand, the major retailer partnership.
The tech is proven, the margins are high, and the demand is massive.
And the upside potential is there, with analyst targets around $6, implying, significant room to run.
And that's all based on two things. That cash buffer we talked about, and the expectation that they execute on this RAS model.
So if you're listening, what's the time horizon here? Is this a quick trade into earnings?
Primarily, I think this is framed as a longer-term hold, 18 to 24 months maybe,
You need to give the MSA time to ramp up.
and time for those G&A expenses to prove they've normalized. But there is tactical potential leading into that December 10K and the Q1 earnings in February, just based on the anticipation of that contract finally hitting the books.
The key question for the market now is whether the high-margin foundation is strong enough to support the massive growth needed to justify the recent capital raises. It's a classic show-me moment, and the next two earnings cycles will tell the tale.
That's all the time we have for today's analysis. Remember to subscribe, like, and comment to stay informed and support Smart Wealth with Joshua.